Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett Fu, it is a merger Monday on Fed Week.
Yeah, I know. There's a lot of news to go through, whether it's IBM, whether it's Netflix versus Paramount, Skydance for Warner Brothers.
That's true. We're going to be tracking that all through Bloomberg TV. But let's get to the biggest stories right now in the nearly $19 trillion global ETF industry. Stocks starting off on a cautious note as the S&P 500 hits a session low. Investors searching for clues here on the Fed's interest rate path.
And we'll discuss how this year has been shaping up as the year of active and thematic ETFs with Todd Rosenbluth of TMX VettaFi.
And we speak with the CEO of Direxion, Doug Yones, to discuss the greatest performing ETF of all time. All that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. So there was a big S&P rebalance on Friday. I'm sure you heard. So the flows are all kind of whacked on the weekly level. So I thought, let's take a step back and look at, again, what I'm calling the triple crown. ETFs are going to break the record in flows, volume, and launches. Let's look at flows first. Here's by asset class. The record's going to come across asset classes. So here's equity, clearly a record. That's 30% over the record. Fixed income, about 25% over the record. Commodity and alternatives, this is Bitcoin and gold having also good years. Like basically everything just saw a ton of money, and now you're seeing flows 30% over the record, and this is a global number as well, so both global and the U.S. Let's look at volume. Now, volume in the U.S. here, but again, across the world, it's the same story. Volume is 54 trillion, probably going to get to 60 trillion when all is said and done. This is the most unusual number to get broken in a good year. Normally, volume goes up when things are bad. So for volume to break at this level, it's going to break by about 30% over the last record, is pretty astonishing. I think it speaks to all the new issuers and action in the market, as well as some of those leverage ETFs, which have brought a lot of the retail trading crowd in as well. Now, let's go over and look at launches, which is sort of like the third thing here. Now, we'd expect launches to go up in a year where the market's good and flows are good, and they did. But here's the thing with launches. If you look at launches, I put U.S. and international in here. This is international, right? That's about almost probably going to end at 1,500. And this is U.S. And you can see how much more they are over the old record. But look how much they are over just 2 years ago. They're almost double. So almost 100% more than 2 years ago. And about 40% over the record last year. So this is probably as good as it gets, Katie. I can't imagine that we see the same thing next year. So we should just enjoy it while it lasts.
Enjoy it while it lasts. Eric, thank you. Joining our conversation now is Todd Rosenbluth. He is head of research over at TMX VettaFi. First off, Todd Rosenbluth, it's great to see you.
Great to be back.
Let's talk about this triple crown, as Eric has been calling it. You have record launches, record flows, record trading volume. I want to start where Eric ended, that you think about the launches that we're seeing through, not just coming through in the U.S. at record levels, but also internationally. Do you agree this is as good as it gets?
Well, it's great to be an ETF analyst or an ETF reporter covering this because there's always something to be able to talk about. And the ETF industry couldn't be healthier. So I'm really excited about that. I'm excited that we've got new products that are coming, some that are risk-on related products, so single stock leveraged or income-oriented products. But we've got some new entrants into the marketplace, active firms that are now here for the first time. Pictet, for example, is a firm that's recently entered in the ETF marketplace. I think I was on last. Yes, that's how I believe you say it.
You have to go back and edit the film then.
We sound like Americans.
You said Pictet like 20 times.
Yeah.
It's too late.
Yeah.
Anyway.
Well,
sounds better when you say it.
But lots of firms that are coming in, and even the established firms are continuing to expand some of those successful lineups. So it's a great time.
So what does it say about the fact that active is really booming right now? Whether it's fixed income or whether it's equity, active is having its moment. And for so long, everyone thought passive was going to eat active's lunch.
Well, it did, and it still is. It is still the majority of the overall assets. It is still the majority of the overall flows, but that gap is starting to narrow. Some of that has to do with the firms that have come into the marketplace and are leaning in more heavily. Some of those asset managers are leaning more heavily. We've seen BlackRock add active strategies into their model portfolios throughout the year, and that's helping to boost things. We are also seeing people just believe in active management in terms of volatility for fixed income, so we've seen that be popular. But I don't want to gloss over, there are some success stories in the index-based ETF world. Victory has an ETF, VFLO, that's gathered over $3 billion. It just launched a year ago. doubled in size. So there are success stories in the index world. It's just easier to focus on the active space.
Speaking of something like that, where the index is smart beta, we would call that passive, but that actually is picking stocks based on active design. Smart beta is counted in passive, and it's this, once a year, all these people worry about ETFs. The latest one is that, oh my God, they're going to ruin capitalism. Now, obviously, I don't agree. Stocks go up and down, even with all these flows. The other thing that the dig is that there's more ETFs than stocks, but there's also way more mutual funds than stocks, too. Personally, this has been coming up my whole career. I don't see any problem at this point. Maybe you do, but as an analyst, I'm sure you have to respond to these some worry articles that come up pretty regularly.
I think ETFs are a way that many more people are getting exposure to the marketplace. I respectfully disagree that smart beta or factor-oriented is active. It is choosing stocks, but it is choosing stocks based on rules, and we understand when that playbook is coming out. And indices rebalance a couple of times a year, sometimes once a year. You just referenced the S&P 500 that went through a rebalance. Companies got added in, 3 of them in, 3 of them out. That's healthy. That's what an index is supposed to do, is supposed to clean things up. I think ETFs are increasingly the go-to vehicle for many more people to get exposure to the equity, the fixed income, and even the crypto marketplace, too.
Let's talk about an interesting notice that we saw from the SEC. I believe it was last week. We know that, over the past several months, we've seen U.S. filings for 3 times leveraged products, 5 times leveraged products. The SEC basically posted these letters saying that it wasn't going to continue with its reviews of these applications. So it seems like a line in the sand has been drawn when it comes to how far some of these leveraged ETFs can go in the U.S., Todd. And I wonder, whether you think this is the end of it, or are we going to see some of these issuers come back and try again with regulators?
Well, I would hope they would follow the rules. And if the SEC has come out and said, we're not going to review these, let's not waste the time. There's enough other great products that are coming to marketplace. We've seen a proliferation of leveraged ETFs that have come to market that are taking on additional risk. I caught my eye, and I know you have Direxion CEO on later on in the show, but they launched a suite of products that are the top 5 companies within a respective industry. Semiconductors, for example, I think the ticker is TSXU, is the top 5 there. So this might be an oxymoron, but a little bit more diversification to your leveraged ETFs. So we have the just semiconductor only. We've got the individual stocks. This is somewhere in the middle for people who want a little bit less risk on.
I'm looking at Bitcoin, currently unchanged at about 90,000, but a long way off from the record highs that we saw in October. Some people are worried about a crypto winter. What does that mean for ETFs tied to crypto and the various other altcoin tokens?
So I'm the least qualified person to probably offer crypto advice on this table.
But that was a big growth area of ETFs
in
all of 2025.
It is. So there was adoption. I think what we've seen is that even though crypto has pulled back and Bitcoin has pulled back, most of the money has stayed in. There have been outflows for some of the products. But what we've seen is also a next evolution of Bitcoin and crypto-related ETFs. I saw Neos launched an Ethereum income ETF last week. We've had Calamos offer downside protection to cryptocurrency. So it isn't just following the price of Bitcoin and Ethereum, but either downside protection or enhanced income.
Eric, what do you think?
Yeah, I mean, only 4% of the people actually left, so it's pretty strong. But still, 40% is definitely a drawdown. But it was up 122% last year. That's 5x anything else. So, I mean, things can't go up that much every year. Like, everybody has to relax a little sometimes. But speaking of relaxing, I'm relaxed because I have a steak dinner coming my way for 0 cost. Todd's going to pay for it. Last time he was here, we bet on whether large caps or small caps would outperform through his...
and you were on team large cap?
I'm on team large cap. Though never bet against U.S. large caps. He wanted to. And so S&P's up 6.2%. Your small caps are up 3.4%. I don't know, man. That's a lot of ground to try to gain between now and the end of the year. So when do you want my restaurant choice?
So a few things. One, the last time I was here on air, you sprung this bet on me. It wasn't that I came to you.
Okay.
You came to me. Second thing is, as far as I know, the year hasn't ended. We are still have 3 weeks left in the marketplace. 300 basis points of the gap has been narrowed in the last month. And I want to just remind you, there was a football game that the Eagles played against the Rams earlier this year. And I believe the Eagles were down at halftime and they narrowed the gap in the third quarter. And I believe the Eagles won. That's the only victory I think you're going to have tied to this conversation.
Wow, mic dropped. I will say the Fed, coming up in 2 days, could be consequential for the small caps bet. So, you know,
if it isn't already priced in.
That's
the Fed is his Hail Mary. That's all he's got.
Well, it's never too late, and we'll be talking about that, I'm sure, when we're together at the Exchange Conference, the three of us.
Nice plug.
You're welcome to join us. You're welcome to join us as well.
That's a pro right there, working that in.
That was
Look at
very
that.
smooth. Todd Rosenbluth there of TMX VettaFi. Great to see you.
We want pictures from the steak dinner.
Absolutely. Yeah, please. Maybe we can live stream it. That would be fun. Coming up, mutual fund growth is set to rise as younger generations access them through their 401ks. That conversation.
Wait, what? Mutual funds?
I know, on the ETF show. This is Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with Invesco, of course. They had the delayed proxy vote for the QQQ fund on Friday. It was adjourned once again to December 19th. Again, remember that Invesco asking its shareholders to approve conversion of the Qs from a UIT into an open-ended ETF. They need 51% approval from their shareholders. Apparently, they are very close, but just short of that threshold. So, of course, we'll continue to follow that vote again on December 19th. But let's also talk a little bit about Bitcoin. It's been in the hurt locker, if you want to say that. We're looking at it measured by BlackRock's IBIT fund, and you can see that IBIT closing out 6 consecutive weeks of outflows. Eric Balchunas just told us that is just a drop in the bucket in terms of the grand scheme of things, but still starting to add up. That is the longest consecutive outflow streak for IBIT since it launched. And let's also talk about mutual funds. We're going to do that on ETF IQ because you take a look at U.S. household ownership of mutual funds. Nearly 73 million households own mutual funds. Fewer than 20 million households hold ETFs. So even though we talk about the growth of the ETF industry all the time, Scarlett, it's important to remember that mutual funds have a very important incumbency advantage.
Absolutely. So let's talk about this more with David Cohn of Bloomberg Intelligence. He joins us now from Boston, some would argue the mutual fund capital of the United States. So David, tell us a little bit more about the numbers that you were crunching when it comes to mutual fund assets, because they're very much tied to 401ks, and because of that, they're not going away anytime soon.
No. Thanks for having me. So originally, ICI had put out a report showing that ownership among middle-income households had risen over 50% over the last 20 years or so. And so what's been happening is, if you think that includes both ETFs and mutual funds, but when you dig a little bit more into the data, as you said, 73 households own mutual funds versus only about 20 million with ETFs. And so when you look at the 401k plans, mutual fund assets keep growing. And then when you think about when investors get access to mutual funds, it's actually the younger generations. And when I say younger, I actually am including Gen X in there. Over 60% access it through 401ks versus only about 35% or so of baby boomers. And so when you think of all the automatic withdrawals from your account, from your employers and everything like that, they're really poised to continue growing.
Yeah, I mean, you think about this advantage place that mutual funds have in 401ks. It makes sense, given the proliferation of those funds, that mutual funds clearly reaping the benefits. I mean, you think about the mutual fund industry, David, they do have this boost from 401ks. And I wonder, what the introduction of potential ETF share classes in 2026 of existing mutual funds is going to mean for the mutual fund landscape as we get closer and closer to the new year.
I think it's actually going to be a pretty slow rollout. Aside from DFA, who's hitting the ground running, I think there's a lot of hurdles that a lot of these firms are going to face. Whether it's distribution or operational. I don't think the back end is ready yet. And so, aside from DFA, maybe a couple other firms, I think it's going to be really a waiting pattern among a lot of the other firms. And while we will see a rollout, I just don't expect to be a big thing in 2026 at least.
Okay, this is the question that I think everyone asks, but we've all known the answer to, which is, do we think that ETFs could ever make it into 401ks?
I don't believe so. I think the bigger competitor for mutual funds and 401ks is CITs. Now, CITs have already overtaken mutual fund assets when it comes to just target date funds. But if you look at the entire 401k plans, mutual fund assets are still greater than CITs. I think mutual funds have about 5.7 trillion compared to about 3.7 trillion in CITs. And so, CITs are going to continue to grow, especially when it comes to target dates. And we all know target dates are the default option on many plans. And so when it comes to the larger and more, mid to large 401k plans, I think CITs are really going to overtake mutual funds. Not next year, not the year after, maybe 10 years from now. But I think a lot of the smaller plans will still have mutual funds and not CITs, just due to kind of operational constraints and the simplicity of having mutual funds.
All right, good stuff. David Cohn of Bloomberg Intelligence joining us from Boston. He is also the host of his own podcast as well. And it's called Inside Active, so definitely check it out. All right, still ahead, we drill down into the greatest performing ETF of all time. Okay, there's a tease, with Direxion CEO Douglas Yones. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence, back with us now for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, as you teased earlier, this is the greatest performing ETF of all time. Okay, it's the triple leveraged tech ETF. So first of all, triple leveraged. If they launch them before, they can do it. No more triple leverage, but this one's on the market, just like TQQQ. Except this one isn't different than TQQQ in that it came out in December 2008, so talk about good timing to start a tech ETF that has leverage. It's 85 bips. Traders love this stuff. 4.4 billion, so very big leverage ETF. Let's look at the holdings. What does this do? It goes to various banks and gets swap contracts, which is basically like a bar bet with a big bank, that it's going to give you 3x every day. So every day, these are different banks, swap contracts. Now let's look at the performance. If you go back since this thing was incepted, it is up a whopping 48,000%. I mean, what else can you say? If you look at XLK, the tech ETF that it's tracking, it's only up 2,000%. And so you can see this is obviously way greater than 3x. Why? The compounding effect. It's rare. Normally you get volatility drag, so I wouldn't recommend holding these long term. But occasionally, if something just goes up like this, like tech did, you can compound this thing. And there's the Qs in there too. So again, we call this hot sauce. I'd even call it a power tool, Katie. But when it works, it works.
All right, Eric, thank you. Joining us to talk about this ETF is Douglas Yones. He is the CEO of Direxion. Great to see you in person.
Thanks for having me back. It's great to be here.
So you think about that performance stat, 48,000%.
Yeah, it's not bad. That's not bad.
Not bad, not rookie numbers there. Is anyone holding a fund like this like that, or is it more used as a trading tool, as Eric said?
Yeah, I mean, look, first and foremost, if you don't understand how leverage works, then let's start with education. Come to Direxion.com. We'll teach you how it works. Traditionally, most of our traders are just that. They're traders. They're not really holding on to these things for that long. But for sure, there's going to be people in some of these ETFs, and there are, that have held since the beginning. And we see that. I mean, even, our own materials, we would always say, look at 1 day performance, look at 1 week performance. That's about what you should be doing, reset, reset. We've got maybe 4 or 5 ETFs that are up almost 400% year to date. So if you bought them Jan 1 and you held them till now, you'd be up 400%. We also have ones that have gone the other way, right? So generally speaking, while traders are using these actively, there are going to be people who are going to try and stay with the momentum, and the trend can be your friend, both to the upside and the downside, and so they will sit a little bit longer in some of these ETFs.
Do you have a breakdown of how many people are in it day in and day out versus those who might be holding on to it?
The best we can do is look at turnover. So we tend to focus a lot on turnover, and we look for what's what's happening in our funds, it's hard to see underneath, right? And it's also hard to see is it you? Did Scarlett make a trade today, or was it a market maker, or was it a bank?
I'm still working, so
yeah,
it's not.
yeah. So it's hard to see exactly. We do the best we can. That's why we focus so much on the educational side.
Yeah, it's interesting. When you look at all the volume in ETFs, that 55 trillion I showed, 10% of that's leverage ETFs, but they only make up 1% of assets. So I'd say they're being used as directed. People are trading them a lot. When you look at these, I think that a lot of normal vanilla investors actually have a little side account in which to have some fun, speculate. Is that what you're finding too,
Yeah.
or is it more young people who are just full to gen?
No, I would agree. I think you've got traditional institutional investors, family office level investors that are really long-term strategic holders. Let's be honest, the markets are exciting, right? Why are we all tuning in every day to Bloomberg TV? We want to know what's going on. We want to be excited. So every investor we're seeing, even the ones that are at the institutional level, they're carving out a certain portion of their portfolio, call it a satellite holding, what have you, where they allocate dollars to trade the markets. It's an exciting time to trade. The markets have performed really well with a lot of volatility. So if you're a trader around volatility, these are the perfect markets. This is direction weather. It's been direction weather for a few years now, but certainly this year has been direction weather.
Well, let's talk a little bit about how far leverage can go, especially when it comes to the single stock ETF space. We were talking about this with Todd Rosenbluth a little bit earlier, that you think about a letter that you and some of your peers got from the SEC last week, basically the SEC saying that it's not going to move forward with reviewing proposed applications for 3 times and 5 times leveraged products until key issues are addressed. And I'm curious, what you do from here. Are you going to come back with revised proposals, or are you going to say this is a line in the sand that the SEC doesn't want to cross?
Yeah, look, for Direxion, most people don't know us. We launched our first leverage ETF in 2008. We're one of the largest providers out there. There was a lot of rulemaking that happened around the derivatives rule that really put everything back to 2x, grandfathered in the 3x, so we could talk about TechL and some of our other ETFs, but really everyone since that point has only been able to do 2x. The ETF industry, as we all talk about every day, is the fastest growing industry with the smartest people in finance right now. Smart people look at rules and they find ways to try and progress the industry forward. A lot of us filed for 3x products. You've had a few filings out there for 5x. The SEC came back and said, doesn't fit the rule. I think the SEC said, appreciate that everybody's trying to be a little bit smart here, but let's look at the math and let's see how it makes sense. So our expectation is people tried, the SEC said no, and we move on.
All right, Douglas, got to leave it there. Great to get some time with you. That is Douglas Yones. He is the CEO of Direxion. And you can read all about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. But that does it for Bloomberg ETF, the television show. I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.